Let's now bring in Tom Lee of Fundstrat, Dan Greenhouse of Solus Alternative Asset Management. Tom's a CNBC contributor. It's so good to have you both with us. Tom, I know you agree with a large part of what the professor said. That's what you're trying to do and impart on our investing audience. Those are the headlines from the notes that you continue to put out. Tough now, better later. Invest for the longer term this year.
That's right. We don't want investors to be panicking now or rage selling. We've had a very painful drawdown, and I know we're facing this huge uncertainty that may not end tomorrow, might last months. But like the other declines in stocks, like the one last year or the ones in 2022, the ones who could endure that short-term pain and took advantage of those declines are going to have good opportunities.
Dan, what if things are different, though, this time? That these tariffs are going to be a favored measure by this president? Whether they're permanent, temporary, months, years, no one really knows. They're not going to be a day. You know that.
Yeah, listen, across the street, every big bank, every medium-sized bank, I'm sure Fundstrat have hosted calls with their clients to discuss what they expect for tariff. And I've been on a couple of those calls, and there's universal, complete uncertainty as to what's going to be announced in even 45 minutes time, let alone 45 days time. So I think it's fair, to Tom's point and to the professor's point, for everybody to have a little bit of fog in their investing outlook right now. However, I want to take a step back here and just note, to the professor's point, that stocks are long-lived assets. Risk assets are long-lived assets. And unless you think a recession is forthcoming and a meaningful decline in earnings is forthcoming, then probably your best bet is to ride this out. And to your point about EPS, 280 right now for the next 4 quarters is basically unchanged over the last couple of weeks. Now, you could say that's the ignorance of the market, thinking that this isn't going to matter, and someone thinks it does. But it also could be telling you that maybe the tariff headlines, which populate all the newspapers, aren't quite as bad as the reality on the ground.
What about that, Tom? At the end of the day, this entire conversation comes down to what earnings are going to be. And then we have to decide what we're willing to pay for the earnings in stock prices. Do you have any level of confidence now that you can see through whatever fog exists?
Well, I think people are making what I would call like linear adjustments to earnings because they're making a tariff assumption, not assuming that there's companies that can find ways to either get efficiency or they're going to get a currency benefit. I think earnings are going to change a lot less than people expect. And the easiest way to see that is the bond market is a very good economist. High yield spreads have not widened dramatically, even this week as stocks took it on the gut. And if you look at one year inflation break even, so the estimated inflation from 1 year from now, 1 year ahead, that's actually fallen 30 basis points. So the bond market is not expecting more inflation. I actually think earnings are going to hold up a lot better than people expect.
Don't you think, though, that to some level it's almost undeniable that margins are going to take a hit, that the companies, by and large, don't have the level of pricing power that they once did because they know that consumers are sick and tired of inflation and they're tired of seeing prices go up. There's no appetite to raise prices, at least initially. You're going to eat it. Yeah. And you're going to see a lower margin, which is the story.
Yeah, and I don't want to get a little dark here, but we know companies were hoarding labor for the last few years, and there was a stigma for downsizing or retirements. But we know AI is actually producing enough PhD level type workers that you could see companies re-engineer. I think labor costs will be one of the solves for why earnings might surprise in the next year.
And let me add, while clearly tariffs are not a boost to margins, there's little doubt about that, there's a shared pain here amongst companies, and it's not so easy. I was watching a news report on one of the political news shows before. They were interviewing someone who said, well, the car is coming in, it was 100,000, now it's going to be 125,000. And that's not how it works at all. Obviously, it's on value added. It's a little more complicated than that. And in the case of margins, Walmart, let's say, is not going to eat all of this. Some of the suppliers are going to eat some of this. Consumers are going to eat some of it. Walmart itself is going to eat some of it. So ascertaining the exact hit to margins across sectors, particularly consumer discretionary, is much more complicated than simply saying.
Well, you're also addressing the so-called the power position, the bully position of the companies like Walmart, who can have that leverage over their suppliers. Not all companies certainly have that.
No, that's fair.
And to that degree.
And maybe I might want to add one more thing. You know, there's going to be a lot of onshoring in the U.S., you know, maybe as much as $6 trillion of capital assets. That's additive to S&P earnings.